What are tax deductions for small businesses? This question I get asked so many times. People don't know what they can deduct. And I get it. It's really, really, really confusing, but it's really actually not. Don't worry, I'm going to break it down and I'm going to explain it to you. My name is Nicole. I'm one of the tax advisors here at Robert Hall & Associates, and we are going to talk about what are tax deductions for small businesses. We're going to talk about the style of your business. We're going to talk about if the business is a service or if it's a product and why does that matter. We're going to talk about how you are incorporated, what's the entity structure, because that definitely plays a factor in it. And then we're also going to talk about business use of home. So these are going to be the three things that we are going to talk about when talking about what are the tax deductions for small businesses. Make sure you like and subscribe so you don't miss out on any of our upcoming videos. Okay, guys, let's get into it. So, congratulations, you've got a small business. I know it's so hard and it's absolutely draining and it takes everything from you, but it's a really big feat. So congratulations on that. Having a small business is a wonderful, wonderful thing. Being on W-2 is the worst. You pay the most amounts of tax. It's so awful to be on W-2. To have a small business, you're able to have deductions. What are deductions? Deductions are expenses that you pay, money that went out so that you can run the business. And this is the key thing. It's going to be ordinary and necessary expenses. So first and foremost, when you're looking about what you spent to keep the business running, make sure that it is ordinary and necessary. We're going to get a little bit into why ordinary and necessary really, really matters in just a minute. Okay, so first let's talk about how are you structured, because this plays a huge thing. If you're a sole proprietor or a single member LLC, you're not taking the same deductions that a S Corp, C Corp, or a partnership is going to take. The deductions that you're going to take if you are a sole proprietor or a single member LLC, because the single member LLC is a disregarded entity and sole proprietor basically is the same thing, means that it's all going to be on your personal return. S Corp, C Corps, and partnerships all have their own returns. And so what ends up happening is you have different rules. The most obvious and easiest for me to explain this is to talk about transportation, to talk about your car. When you're a single member LLC or you're an S Corp or you're not anything, you're just doing it on the Schedule C, you are going to either take miles or the actual expenses that you have for your car. Right now, it's 67 cents to the mile. And so you can take, if you drove 100 miles for your business, and keep in mind, not from your house to your office, but from your office out to meet a client, whatever you need to do for business. But driving to the office is does not count because everybody drives to the office, unless you work from home, but you need to talk about your employer about that. If you drive 100 miles for your business, and keep in mind, we're talking about from the office to somewhere else, not your house to the office. If you work from home and you had to leave your house, like if you have a home office, whatever, and you had to leave your house for your business to go see a client or whatever, that's the miles that's going to talk. If you have a separate office, we're not taking your house to the office and your office back home. That's just normal life. Being on W-2, you have to drive to the office and stuff, so you don't get that. But anytime you're going out to see a client or to do something else for the business, that's normal, like ordinary and necessary, you're going to count those miles. And so let's imagine you drove 100 miles. That's pretty low. But let's imagine you drove 100 miles because it is 67 cents for each mile. You're going to be able to take $67 of a deduction. Keep in mind, 100 miles is really, really low. Usually people are like a few thousand, depending how big their business is. And we'll get more into that as well. So you can either take the mileage or you can take the straight expenses. So if you have a separate car and you know the exact amount that you're spending on oil changes, tire rotations, or, tune-ups, or I don't even know if that's still a thing. But the amount of stuff that you spend on your car, and that car is only used for your business, you can take that straight expense. And so if I have a second car, this car I'm using for my business, and I spent $100 on tire rotation stuff, then I'm going to be able to take that $100 deduction. You have to think about gas, all of that kind of stuff. And sometimes it's better for you to take the actual expense, especially if you're in a state like mine where gas can be very, very high, and because that counts. If it's not a second car and it's like you have one car, then you just take a proportion of what you spent. And so if you drive, so you'll need to make sure you calculate how many miles are personal, which you can just, take a picture of your odometer at the beginning of the year and take a picture of your odometer at the end of the year. And then if you consistently do it, you're taking one picture every year. So you take a picture of the odometer, and then you know how many miles you driven throughout the year, and then you should be tracking how many miles you drive for business. You need to track that. And so then you can subtract, and you can understand, you can do a little bit of math, and you can understand what's the percentage of miles that you use for business and what's the percentage of miles that you use for personal. You need that number if this is your primary vehicle, even if you're not using the mileage deduction and you're actually itemizing expenses. So if I drove 10,000 miles through the year, and keep in mind the average American drives 10,000 miles a year, Californians drive a little bit more because California, have you been here? We love to drive. Not really, but anywho, we're in the car a lot. And so Californians on average drive about 12,000 miles a year. And so if you drive 10,000 miles a year, 5,000 of it was spent personally, 5,000 of it was spent on business. Great. And so now you're going to do a 50-50%. Like you'll do 50-50 split. And so you look at all the gas that you spent, look at all the dealership tune-up thingies that they did, and then you can just, divide that in half, and then half of that will be your deduction. You can compare that to what you would get for an itemized deduction, and you see which one is larger. So if you have a business and you're driving your car for more than 50% of the time for the business, you're going to be able to take those deductions, and it's going to be done a little bit differently because you don't have the option to take miles. Miles is only an option when it's on your personal tax return. And so if you have an S Corp or a C Corp and stuff, you actually end up getting to take miles a little bit easier. And because reporting for an S Corp or a C Corp or a partnership is more intensive for these things, it's actually easier for you to take these deductions, and the government's going to have less questions because as the tax preparer, we're required to give more information. This is also why we charge more for these types of returns, because I would love to give more information on the personal side, but there's nowhere for me to give this information. If you give more information about something that I know they might have an issue with, the odds of them coming back to ask you a question, i.e. an audit's usually just a question that they don't understand. If I gave more information, it's going to reduce the chances of audits. And so if you have really high business expenses, it's very, very advisable that you really look about how your entity structure is set up, because Schedule C with high expenses, especially if you're showing a loss, is problematic. And so, yes, there are different rules about deductions depending on the entity class. The car expense is one of the most common that people hear about, and so that's why I gave that as an example. Let's talk about ordinary and necessary expenses. When people go, I don't know, Nicole, what can I take? Can I deduct my utilities? Can I deduct the meals? People always about meals. Can I deduct the season tickets to the Dodgers that I purchased? Go Dodgers. Well, one, it all depends. It's accountant's favorite answer. It depends. But really, it depends on a couple of things. It depends on the structure, right? As I talked about, it depends on how we're set up. And then it also depends on how much these deductions are, because it's ordinary and necessary deductions. What the IRS does, let's use the IRS as an example. All state agencies do the same thing. The IRS reads what you determined your business offers. When you're filling out your tax return for your business, you identify what you do. Are you selling a product or are you offering a service? And you specify what that is, what that service is, what that product is. It's called your NACI code. And with that, they know what the average expenses are. Hello, it's the government. They have so much information on all of us. They know all this information. And so they know what the average doctor or pediatrician, yes, a pediatrician can have their own business. Doesn't mean they need to have their own office. There's very, very many types of people that can have their own business. And oh my God, if you have that option, please, please, please get off of W-2. You're going to save yourself so much in taxes. It's insane how much you save in taxes. Yes, you have to do a little bit more work, but you can even take a lesser salary from your company to be 1099. And keep in mind, the company needs to make, well, you don't even have to be 1099 because it's going to go B2B. And so you don't have to 1099 business. Sorry, I'm digressing. But getting off W-2 is really great. Make sure the company obviously allows it and you qualify. But if you're a pediatrician, the government knows the average expenses that a pediatrician has. Keep it like a real estate agent. Real estate agent and a pediatrician are not going to have the same type of expenses. Real estate agent, your transportation, gas, marketing expenses are going to be so much higher than a pediatrician. Pediatrician might spend some more money on like rent, or they might spend more money on equipment or salaries because they have to pay for the people in the office, and so the government knows what the average range is, and that's where you want to be. Average. Based on your income, you want to have the average amount of expenses because they require ordinary and necessary. And so if you're doing something that's not ordinary, it's okay if it's a legit expense, but you're more likely than not, depending on what it is and how much it is, you're more likely than not might spark some attention. More likely than not might. It depends. You might spark some attention, which is fine. You can have attention. You just need to make sure that you're very confident that this is a legit business expense and that you have the evidence to prove it, because you might spark some attention. What am I talking about? Like making sure like you're average. If I have $10,000 coming into my small business, this is gross before expenses. I have $10,000 coming into my business. It is outrageous for me to have $100,000 of expenses. Like that's just not ordinary or necessary. And depending on how we're structured, can you take that $100,000 or not? Like there's ways, like if it's legit, there's ways that you can take it, especially depending on how we're structured, because the structure really will mean something. Like I'll never do that on a Schedule C. Like that's going to be an audit. So easy. Like I would never do that on a Schedule C. And so you need to make sure, but you might not take all the expenses in 1 year. You might, depreciate some. It depends. Sorry, but it just does. And so you need to make sure that your expenses are average, or you're setting yourself up so that you can prove that your expenses are legit, ordinary and necessary. Really, really conservative people and really, really aggressive people are just as likely to spark attention. Obviously, the more conservative people, like it's not the biggest of deals because you're paying more in tax. And being super aggressive isn't a big deal either, as long as you make sure you prepare and you're doing everything legit. Like aggressive does not mean illegitimate. It just means aggressive. And so you, as the client, you're the one that's going to determine which way you want to go. That's really shouldn't be a decision for your accountant. That should be, or your tax advisor. That should be a you decision. Your tax advisor should just present to you your options. And so you can know what your level of risk is, the level of risk that you want to take on is. So we've got the entity structure, we've got the ordinary and necessary expenses. And so when people come to me and say, Nicole, I don't know what I can deduct, I tell them, first of all, I don't care how you're structured. You need to make sure you have your own bank account. The business needs to have its own bank account. That is not your primary account. And I always recommend people to at least, at a minimum, be a sole proprietor so you can put the bank account in the EIN of the company. But if you're just, loose and fast and it's a small business and you don't have its own EIN, it still needs its own separate bank account. All the income and all the expenses need to go out of that one account. And then it's easy to track what those expenses are. Let's imagine, because, I'm just starting my business, I have $10,000 of expenses and I only had $5,000 of income. And so there's not enough money in the bank account for me to pay my expenses. Should I have those expenses go out of my personal account because I have $10,000 of expenses and $5,000 of income? No. You should transfer from your personal account into your business account and keep all of the expenses coming out of your business account. If you want to get a credit card because you want to do points and all of that, that's fine. You can open up credit cards with your business, and it should be done under your business. You need to keep it really, really clean. The accounting for your business is really, really important. The last thing you want to do is be going down the road 5 years later, taking all your deductions, and then 5 years later, the IRS comes back at you and says, sorry, boo-boo, those deductions don't count, and we're attaching penalties and interest for the last 5 years. You don't want that. And so you really need to have clean books, clean accounting. So when people ask, which I've said multiple times, what is it that I can take for my business? What did you use for your business? What are the legit expenses that you have for your business? I usually tell my clients to go ahead, create, especially if they're in the beginning of this and they're first starting out, to create a P&L for their business and to create a P&L for their personal life. Profit and loss statement. It's just basically a summary, an annual summary of all of your expenses. If you create one for your business and then you create one for your personal life, now I have full bits of information and I'm able to help include different expenses that maybe you thought were not included or couldn't be included. Let's talk about your house, because this one people get really messed up on. Regardless of how you're structured, there is a way for you to include the expenses of your house or part of the expenses of your house because you work from home. And so let's say if I have my house and I bought my third bedroom, I changed it into my office, and I bought furniture for this. This is normal. This is a necessary expense. And currently right now I have a TV in my office and I'm not even in my home. This is an ordinary expense. Why is it necessary? Because I use it for business to show my clients their stuff, but we're not getting into me. But this is normal for you to have these expenses. You need a chair, you need a computer, you need all of these things, and these are deductible regardless of how you're structured. Depending how much you pay for it, depending on what the item is, will determine if you can take the full expense in 1 year or if you have to spread that expense over several years. It all depends what the item is and how much you paid for it. That's how you determine depreciation. But you're able to include your house expenses. And so not all of them, obviously. There's different ways that you can get about it, but like your internet, your utilities, all of these things that are going to increase because you have this business, you're able to include. Does that mean I'm going to include my property tax, my mortgage interest? Yeah, I can include it a little bit if I'm a Schedule C, but you're going to get those deductions either way because you'll get it on the personal side. So even if you're not a Schedule C, you still get that kind of stuff. If you're an S Corp or a C Corp, you can also get those deductions included in as well. But this is very, very important that you understand what your normal expenses are and how much they've increased because of the business. And so we're not taking regular, I pay water. My water bill's not going to increase because I have a business. Like that's not going to change. We talked about your entity structure. We talked about the types of deductions that you can take and the difference with the entity structure. We've talked about ordinary and necessary expenses. And then we've also talked a little bit about the accounting, which is really, really, really important. Please, please make sure you have a bank account solely dedicated to the small business, regardless of how big or small your business is. And then we've also talked about business use of home or just getting in some home expenses, which can be done regardless regardless of your entity structure. If you guys have more questions, please let us know. There's a link in the bio, or you can go to our website, roberthalltaxes.com, and you can sit down with me or with one of my amazing colleagues and have a free consultation. Thank you guys so much for watching, and I'll see you guys on the next one. Bye-bye.